Here's my dab.
Oh, yeah, that is terrible.
Doesn't taste good.
No, that does. Oh my God. All right, this is the Hot Wings edition of the Farm to Markets, where we're going to discuss the topics of the day while eating chicken wings topped with some of the country's spiciest hot sauce. Today's show is going to be based on the format of the YouTube show Hot Ones, where they ask hot questions and eat even hotter wings. We'll start with the mildest sauce first and work our way up from there. So to get started, the first sauce is going to be Ginger Goat from the Canadian company Ginger Goat. Ginger Goat is supposedly a billy goat kick of zippy, throat-clearing ginger root with smoked pineapple and Carolina Reaper peppers. Ginger Goat clocks in at 55,000 Scoville heat units on the Scoville scale. And for those that don't know, the Scoville scale basically measures the concentration of capsaicin and gives some idea of how hot the sauce will be. For reference, Tabasco sauce can be anywhere from 2,500 to 5,000 on the Scoville scale. So again, we're going to start with the ginger root. So dig in.
All right.
And these are basted.
Yeah.
The first two, right, Tom?
That's right.
And I'm going the cheapo route. Some of my daughter's chicken nuggets.
All right. It really sits on your lips. We've often talked about cryptocurrencies, non-fungible tokens, and virtual real estate on the show because of their popularity, mainly with younger investors who believe it is a way to make easy money. However, some in the investment industry worry that these types of investments are teaching bad habits about saving and investing and may permanently turn younger investors away from traditional investments. What do you think? Do you think this is actually the case that younger investors are just going to stop investing in stocks and bonds?
Me personally, I think they are a symptom and not the disease. So I think it's a combination of factors. I was thinking about this and I came up with two kind of big things that I think are driving younger people into crypto and NFTs and everything else. So my generation, as well as Drew's and Tom's, we've kind of had a rough start, at least not necessarily our experience, but a lot of people in our age group have, where, you know, many of us were just starting out in our careers right around the time when the financial crisis happened. And then not even a decade and a half later, everybody's losing their jobs again, the COVID crash, that kind of deal. Everybody's still trying to figure out how we come out of that. So in a lot of cases, millennials are trying to play catch up. When it comes to wages, there have been a number of studies that have shown like our generation millennials will see like permanently depressed wages due to the financial crisis, mostly because of, you know, the 5 to 10 years following it, where jobs were just not paying as much as they were straight out of college, that kind of thing. Another big issue though is that, you know, there's just a totally different world from the world that our parents grew up in. So like baby boomers or early Gen Xers going into a lot of college debt, or spending an exorbitant amount on a starter home was a lot less common back then. And there's a variety of reasons for all those things. But so I think millennials are looking at that like, you know, they have $50,000 to $100,000 in debt, basically day one of their career. And a starter home, you know, the most basic house you could buy is for many millennials out of reach. And so I think they're trying to take a shortcut, trying to make up for this lost time. And when you see, you know, I did the math, it's something like 17.5% is the time value of money total return average for the S&P 500 since the financial crisis. But things like Tesla or Amazon, they're averaging like 40 to 65% annually. And then cryptocurrencies are even higher than that. So I think a lot of millennials, younger investors see those as a way to make up for ground that whether or not they actually have, that they've lost. So again, I think they are a symptom of what millennials think the problem is. And so, yes, I do think that they're keeping people from buying more traditional investments, but I think those are some of the reasons why.
The way I see it, and actually, how'd you guys feel about that first one?
I'm going in for more.
My mouth's kind of.
My mouth
right
feels
now.
fine. My lips are on fire.
All right.
Yeah.
So, Tom, I apologize. Could you repeat the very end of the question again?
Yeah. Yeah. Alex is going to need like first aid on that finger here in a second. So he obviously didn't think it was that hot. All right. So the end of the first question is that, do you think investors are completely, or young millennial investors are completely turned off from stocks and like traditional investments like stocks and bonds?
Gotcha. That's right. So the way I see it, if traditional investments like stocks, bonds, and cash, imagine those of like the fundamentals of the game of basketball, then cryptos, NFTs, and virtual real estate would basically be like trick plays in the game. I don't like to hate on cryptos, NFTs, and virtual real estate too much because they're basically just a type of alternative investment. And when I say alternative investment, that generally refers to anything outside of stocks, bonds, and cash. Alternative investments typically include things like hedge funds, business holdings, venture capital, private equities, and commodities, things like that. So alternative investments, they're generally uncorrelated with stocks and bonds, so they can actually be a great addition when you're constructing an optimal portfolio. I remember when I was working through my SEMA coursework, I had to construct a bunch of different portfolios. And I remember in most cases, 10 to 15% allocated to alternative investments actually yielded the most optimal portfolio. So there is a time and a place for them. Do I think that younger investors are forming bad habits? I think they're just focusing too much on learning trick plays and not enough time on the fundamentals of the game.
I think that every generation has its magic beans that are sold for the family cow. And I think that your generation, gentlemen, crypto and some of these other investment opportunities are your magic beans of the generation. When I was coming up in the business, I met with a lot of people who were my age, and instead of chasing cryptocurrency, they were chasing multi-level marketing opportunities. And not twice a week, but at least once a week, somebody was coming to my office and telling me how the stock market was a huge gamble, a huge risk, and certainly a foolish endeavor. But selling Melaleuca or some kind of special bean from Micronesia was certainly the get-rich-quick scheme of the generation. Well, now 25, 30 years later, I'm still here, and a lot of these multi-level marketing schemes are gone. People are always trying to move up the timetable for becoming wealthy, but to Drew's point, the games are won by being very, very good at the fundamentals and following the rules, buying quality investments, properly diversifying, buying things that are appropriate for you, and being really wise with the income generated. If you just stick to those basics, most Americans can be financially secure by the time they retire. And all these other distractions are really good at getting people off of actually winning the game.
From the people that I see that come in my office, that was always like one of the things, especially millennials, especially in their mid to late 20s, they always want to talk about cryptocurrency, alternative investments. The thing is, though, is that they have 90%, at least what I've seen, they have 90% of their investments in traditional stocks and bonds, and then they have maybe 10% or like a couple of $100 in like Coinbase, buying like Bitcoin, or they maybe bought like an NTF or something like that. And realistically, they just dabble in it. And I haven't seen any of them full on just have 100% of their portfolio in it. So everybody that's been in my office, that has certainly not been the case. I read a Wall Street Journal article a little while ago where, some kid, who'd done really well with it, had 90% of his life savings in cryptos, virtual real estate, and all that kind of stuff. And he'd done fine. And to some extent, I think there is some people out there who think that, traditional investing is going to be boring relative to these because you don't get the same type of gains. But I also think that the market has a way of getting people to like kind of see reality is that things don't go up forever, and there's going to be a point where you're going to be in a correction. You're going to buy something really high, and you're going to be down as just as much as you've been up. And the market has a way of bringing people back to reality. And I think it's a matter of time before you're kind of in the heyday of cryptocurrencies and stuff now. If something ever comes along that's different, is more the rage than what's going on now, a lot of these things are just going to take it in the shorts, and people who have just leveraged themselves up to the eyeballs are really going to feel it. But to answer the question, some of the things that have been floating around in our industry, no, the people that have been in my office, that has not been the case. They all seem to treat this just like we treat the hot sauce on the wings, and they have a little bit of it, but they're not going crazy with it.
Some of my experience has been a little bit different, Tom, in that I've had millennials who have called me and with an incredible amount of hubris explain how wise they were to invest in cryptocurrency. Now, this was 5 or 6 years ago when it was just kind of coming into its own. None of them are independently wealthy as of today. And if you take a look at the historical timeline of cryptocurrency, there have been lots of opportunities for people to make money. And there's also been wonderful opportunities for people to lose money. And I think the vast majority of people who have dabbled in cryptocurrency have lost money. Now, there have been people who have made money, and we've all met folks who have, but I haven't really met anybody who's had a life-changing experience on the positive side as a result of their investment in some of these things. It's been fun. And when a first-time investor who's 23, 24 years old, they put $300 into cryptocurrency and it turns into $1,200, they think that they've come across the fountain of youth or something. But the reality is that for every person who turned their $300 into $1,200, there's a lot of other people who turn their $300 into $80. So,
and no, that's a good point. Is that and people are right to you did make a good investment. You bought Bitcoin, you put out $300 in it. It did turn into it is a great investment. Thing is that you only put $300 into it. I know one person who put substantially more than that in it and is doing quite well with it. But most of the people I talk to who are bragging about their cryptocurrency, I guess Tesla doesn't really fit in this conversation, but their NTFs, their virtual real estate, they only put like $50 in or $100, where is that if things do go south on them, they're not breaking the bank. So when they tell me about their 2,000% return, they only end up with $2,000 in the bank, and it's it's less impressive when I see you only put a little bit of money. It's more impressive when you put your life savings in, you come out a millionaire. So far, I've not seen a lot of people do that, and I've only read about it in national newspapers of the people who've actually done that. And I've seen zero articles of the people who put it, all their life savings in when Bitcoin is at 60,000 and lost 30% of it. I've seen zero of those articles floating around.
Even if you
when you actually win at it, Tom, they actually name a tax reform proposal after you.
Yeah. Yeah, exactly. Yeah, like Peter Thiel. Yeah.
Yeah. Well, even if you do pull your life savings into cryptocurrency or an NFT or something like that and become an overnight millionaire, you have to maintain that, and you're still violating the QDI rule. You're not properly diversified, so you still have a long road ahead of you. I like to tell people investing is a turtle race. If you want to be a rabbit, you might as well just go to casino.
I think my final thought is on crypto in general. I think you have a lot of young people who treat crypto the same way that a lot of young people treated like the gold rush in the 1840s, 1850s in California. The first people who got there were the ones who made all the money. Everybody else who made money was selling things like tools and pants and tents and everything else to all the people who showed up later. So like Coinbase and Bitstamp and all these other places are making billions of dollars. And yeah, somebody's going to find a big chunk of gold and take it back home. But for the most part, most people were just scratching enough gold dust out of the soil to pay for the trip home. Every so often you hear somebody strike it rich and they start a YouTube channel or they post their experience on like the Reddit Wall Street Bets subreddit. But for the most part, everybody that I've known is either made a little bit of money or lost a little bit of money, but nobody that I've known who's done it has had anything life-changing come from it. One of my friends, he's made more money on roulette than he's made on crypto, and he's put more money into crypto than he did in roulette. So that just tells me to go to the casino rather than buy a coin, but what do I know?
All right, the next sauce is called The Bomb, Beyond Insanity, from the company Spicin' Foods in Kansas City. From what I've read online, The Bomb is basically bear repellent with a different label. While The Bomb only clocks in at 135,000 Scoville heat units, its notorious punch comes from the fact that the sauce is made from pure pepper extract, making it feel if it is actually closer to 1 million plus on the Scoville scale.
There's my dab.
Oh. Yeah, that is terrible.
Doesn't taste good.
No, that does. Oh my gosh.
The ginger goat actually, at least I thought it tasted good, so I went back for more. That one, I will
Ginger
not.
goat's reasonable. This one is this one's coming on strong, and it's definitely clearing my sinuses and my ear canals.
Yeah.
This is like pure gasoline.
Oh, all right. To raise revenue for the infrastructure bill, the Biden administration has proposed a 1% tax on stock buybacks. Wow, it just keeps getting hotter. So to raise revenue for the infrastructure bill, the Biden administration has proposed a 1% tax on stock buybacks. Stock buybacks are a strategy where the company buys back, shares. Sorry, this is difficult. All right, to raise revenue for the infrastructure bill, the Biden administration is proposing 1% tax on stock buybacks. Stock buybacks are a strategy where the company buys back shares of its own stock to reduce the number of outstanding shares, which can improve the per share earnings as well as increase the stock's overall price. Do you think taxing stock buybacks are a good idea? And do you think the 1% tax will actually deter companies from performing stock buybacks?
Personally, I don't think it's going to be much of a deterrent. 1% when we're talking about potentially billions. And if they take some of their stocks out of circulation, it just, might make them even more valuable. I don't think it's going to deter very much. It's not going to raise much revenue either. The math on that was there have been $5 trillion in the last decade in stock buybacks. About 10% of them, or about 500 billion, has been Apple alone. The 1% tax would have not really raised much revenue. I think it was 50 billion was the estimate that they came up with, had they been able to capture the tax on every single dollar in stock buybacks. We spend more money on the mating habits of sea turtles, researching that than this would have raised, most likely at this point. So I don't think it's going to deter it. It's not going to raise revenue. If anything, it's just going to create another hassle. In general, I don't have anything against stock buybacks. If the company's primary responsibility is to deliver value to their shareholders, and if they're buying back their shares and helping the shareholders who own their stocks see an appreciation in the value of that stock, then they're doing exactly what they're supposed to be doing. Whether or not you think that's a good thing or not, that's a different question. There's a lot of Democrats in Washington that don't necessarily think that that's a good idea, but I don't really have anything against it. I don't think it's going to deter much of anything, and it's not going to raise any revenue. So I don't know why we would do it other than to just, make the rich pay.
Should we call a paramedic to go in and provide first aid to Drew?
I'm feeling it.
Oh,
kind of a delayed effect.
Yeah,
But,
it really ramps. You give it like 5 minutes, or it's like 3 minutes, and it really, it's like a fire in your mouth. It's
Yeah.
pretty hot.
Mm-hmm. So I think the Biden administration is just ruffling through the sofa cushions. They're looking for who they can shake for loose change to fund their social spending and climate package. And in this case, it's the big, greedy, evil capitalist corporations that do unethical things like buy back their own stock. I think companies have every right to buy back their own publicly traded stock, just like you and I do. Share buybacks are just a strategy that companies can use to consolidate ownership. They can increase their valuations. They can do it to thwart potential hostile takeovers by other companies. And it can just make use of extra cash. Whatever the case, I don't think companies have their prerogative to do with whatever they want with their money. If they mismanage it, then shareholders are going to fire them, or they're just going to go under business. Will it deter companies from performing buybacks? I guess there was a CNBC survey that showed that 55% of US CFOs said that the buyback tax would cause their company from buying back their shares. So if this happens, will companies stop buying back their stocks? Will it may decrease the amount of money invested in the economy. It could decrease the prices of many US stocks, but I think it'll just do more harm than good. Overall, I'm not a fan of this move. I think it's silly.
There's an old saying in our industry that you get more of what you subsidize and you get less of what you penalize. And what we like it or not, taxation is a form of penalty. So following that particular maxim, if they're going to impose a tax on stock buybacks, we're going to see less stock backs or buybacks. Now, whether that's an absolute, ceasing of all stock buyback activity remains to be seen. There will always be somebody that they can come up with a good argument for doing so. But I think in the big scheme of things, it's not going to raise a whole lot of revenue, and it's not going to come up with the funds to pay for this infrastructure bill. So it's going to lose no matter if it gets implemented. It's not going to work, and I think that ultimately it's probably going to get sent to the cutting floor before it actually gets out as part of true public policy, because it's just another idea they're throwing around. But because it's doomed for failure from the start to do what it's supposed to do, I don't think it's actually going to make it.
If I could just say something on that, there's a lot of instances like that where you see these ridiculous things stuck into bills, and the only reason they're in there is not because anybody ever thinks they're going to be implemented. It's because they want to throw 10 things into this bill, knowing they only want 2 of them, and the other 8 they can just throw out and say they compromised when they ultimately got exactly what they wanted anyways. So if that's the case here, unclear. I mean, I can't imagine that anybody thinks this is going to make a big difference, but I think there's at least a good chance that that's what we're seeing here with this particular tax.
Yeah, you pretty much said it. I mean, it's just going to work itself way into the calculation to do that, in the calculation that they do to decide if they want to do a stock buyback anyways. And if they have to take 1% of whatever they gain off the top of it, they'll probably still do it. And like you said, yeah, it's not going to be a huge deterrent, but it is a way just to generate some revenue. And, if they have to give it up, it can be a bargaining chip in what else they're bargaining for.
Mm-hmm.
But ultimately, it's not going to raise revenue if it passes. Therein lies the problem. And that's why we're seeing folks like Joe Manchin and Kristen Sinema who are balking at these ideas, because they see that it's pie in the sky fantasy to think that you're going to come up with some of these ridiculous tax ideas and you're actually going to raise the revenue to make the tax law revenue neutral. They're not going to raise the taxes. People are going to change their behavior to avoid the taxes, and tax collections are going to be about the same, but they've already made the promises of what they are going to spend the money on, but there's no money.
Right.
So they're going to say, yeah, by taxing everybody who makes a left-hand turn with their vehicle, we're going to raise $400 billion. And people generally will make a 360-degree right turn to avoid the tax. There's no tax collection, but the money was already spent in the legislation, and we just get deeper in debt.
Exactly. And that's what I mean by raising revenue. I should say it gives the illusion of raising revenue. It's like, it's like, how are you going to pay for this? When I take Emily to the store and she wants me to buy her something, I'm like, well, how are you going to give me the money? She's like, well, I'll give it to you when I get home. I'm like, all right. And then we get home and she's like, well, why are you taking my money? It's like, well, because you said, it's like you said you're going to give me your, you bought it. She's like, but you bought it. It's like, well, no, I mean, technically yes, but no, it's just a ploy to make it look like you have money. And then after it passes, you kind of pull the rug out because nobody actually follows through on it. So yeah.
If it stays in the final bill, it's just to get the CBO's stamp of approval.
Yeah.
That's really what it is, I think.
Okay, for the last sauce of the day is Apollo by the Heatness, and this is made from the Apollo chili pepper, which is a cross of the Carolina Reaper and Pepper X pepper. So it's a cross between the Carolina Reaper and the Pepper X. It clocks in at 2.5 million on the Scoville scale and has been featured as the last dab on the YouTube show Hot Wings.
This is the first time I've actually felt the heat.
Really?
Yep.
I actually like the flavor on this one.
Yeah.
Yeah, this actually has the best flavor. I did not like the ginger.
Really? That was my favorite one flavor-wise.
I like this one a little bit better. It's a little hotter. That last one tasted acrid. And I was glad it didn't last as long as I thought it was going to, but if it did, boy, I was going to be in a world of trouble. This one is actually getting pretty hot. I can feel it on my lips, under my tongue.
Yeah, another.
All right, so for the last question, seeing that we have everybody here observes Christmas. What? Woo! So this is a lot hotter than. It's hotter when you baste it. But the last question is, what is your favorite holiday tradition, if any?
So I'll give you two. When I was a kid, and we haven't done it up until now, we have our first child, we're bringing it back. But when I was a kid, we mixed glitter in with oatmeal, and we would scatter it all over the lawn and throw it on the roof of the house because that was reindeer food, because they had to have like magic food. And then the newer one that we've been doing, so we'll have a Christmas tree, and then we use a real tree, and we will keep it, strip it of all the branches, and just let it dry out for the year. And then the next year we just kind of burn it as a Yule log, typically on or around the solstice Yule, and just kind of reminisce about the last year with friends or family or whatever. And then we'll take some of the big chunks of charcoal left and then use that chunk of charcoal to start the next year's Yule log. So we've been doing that for a few years now, and we think it's fun, just is an excuse to get everybody together and hang out by the fire. So. Whew.
Kayla and I, my wife,
over there,
the last few years, we, on Thanksgiving, we'd always do family Thanksgiving, but we'd also go out for sushi. So we've been keeping that up for the last few years.
Nice.
I enjoy gathering all of my family around the table and then calling them out for all the ways they disappointed me over the years. And then we dance around an aluminum pole.
Festivus.
Festivus, yeah.
Wonderful. When does the wrestling begin? In the feats of strength.
That's after dancing around the aluminum pole.
Okay.
Hey, Tom, can you answer so we can wrap this up?
Yeah, this one hurts. This one hurts quite a bit, actually. Yeah, our thing is that, after Thanksgiving, we go get a Christmas tree. And I'm really going to drool on my plate here for a second. Jeez. We go get a Christmas tree, bring the kids home, we let them watch a Christmas movie. You make some sort of festive dinner. And then I usually make some sort of like a stovetop hot chocolate, which is different than hot cocoa. Because in cocoa there's powder, but in this you actually melt. You actually melt chocolate. So it's pretty. It's been pretty fun. We've been doing that for a couple of years now, so it's been great. All right. Well, I'm gonna go stick my head in a bucket of ice water after that last one. But Appreciate you joining us for the Hot Wings edition of Farm to Markets.
That was great.
See you
We need
next
to do
week.
that again. Different ones.
Absolutely.
Yeah.